Hello, everyone. So let's come to the next important part of the third module, that is trading mechanism or the trading process in the futures contract. So here we'll be basically dealing how the hedging activity is happening in the futures contract. This is an important part B question as well as the part C questions too. So in this, we are going to learn not only that, we'll be learning about various other important terminologies. The first is about the trading process. So how is the trading process and what are the steps in the trading process here? Selecting a brokerage house, opening a trading account, choosing a commodity or a financial instrument, whether you want the agricultural commodity or a financial instrument, then study about the different contracts, costs, and the goods and all, then develop a trading strategy, and finally purchase a futures contract. Now let us see the futures. Once you buy the futures, okay, how to trade it? First of all, you place an order. So placing an order through the brokerage, through the brokers. Then after that, role of the clearing house. Here we have the NSECL, that is National Stock Clearings Corporation Limited. They have the clearing house, which is the clearing house of the National Stock Exchange. It has members which are called the clearing brokers. They act as an intermediary between the investors and the exchange. Now, there are some important functions of clearing houses, very important. This is also important to part B question, sub question. So first, to provide a quick and simple way of trading for the traders to settle their contracts. Then to simplify the deliveries against the futures contract by matching the delivery by making shorts to open, selling and all. Then provide uniform continuous protection against the default on the contracts by guaranteeing the performance of the parties to contract, recording and settlement of the day-to-day results and all. Then we have acting as a legal counterparty to the buyer and the seller. Then monitoring the net worth requirements of the members, responsibility being taken for the risk management of its members and doing inspection and surveillance accordingly, computing the net gain and loss on the members' position, be it the long position or the short position, buy or sell. Then tracking the records of all the transactions during the day, matching the transactions, reconciling the sales and purchase accordingly, doing this daily settlements and so on. Now, next, after the second step, we have third step in the futures trading mechanism is daily settlement. Now, here the settlement is basically done on the daily basis, and later the last step is a settlement, that is physical delivery cash settlement, offsetting position, and the short selling. Let us see what is all about offsetting. It's a process of carrying forward the transaction by changing the sides, that is entering into a reverse contract. That's called offsetting. Setting off, that's meaning. Then we have the short selling, that is selling the assets which are not owned by the seller and buying them back at a later date. That's called short selling, which is also known to be shorting, we say. Next, we are going to see an important term, that is margin system. What is margin system? Margins means they are the amount needed to be paid by the dealer in respect of the futures position to ensure that both the parties perform their contract obligations. And it is also called, there is the performance bond. This process is called margining. Margin normally ranges between the 5% and the 10% of the face value of the contract price. Its main objectives is to safeguard the interest or safeguard the integrity of the futures market, then ensure the performance of the futures contract. There are some important types of margin system. We have first is called the initial margin, the margin which is to be paid at the time of entering into the contract, deposit that is required on futures trading to be paid by both the parties, that's the buyer and the seller, to ensure that the terms of contracts are fulfilled. It is also called ordinary margin. It's equal to 2% of the contract value. The second type of margin is maintenance margin. Here, the minimum balance to be maintained throughout the duration of the contract, however the lifetime or the time period of the contract may be. Here, this margin must be maintained by the futures trader once a position is taken. It's equal to 75% of the initial margin. If the future prices move against the investor, then the margin amount falls below the maintenance margin. In such a case, the broker makes a call, that is asking the client to replenish the margin amount to pay the variation or the additional fund, which is called the margin call. Third type of margin is variation margin. It's a shortfall in margin which is to be remitted properly. If the investor's margin account falls, that is when the losses occur. Below the maintenance margin level, variation margin must be added to the account to bring it back to the initial margin level to keep the position open. It is the difference between the initial margin and the balance in the margin account. Additional amount deposited by the trader that is with the broker to bring the balance of margin account to the initial margin level. Then last but not the least, that fourth type of margin is exposure margin. It is imposed on the index futures. Currently, it is 3% of the notional value. Next is the important point, that is about the marking to market. What is marking to market? It's a short answer question. System of daily settlement in the futures contract is called marking to market or marketing to market. It's settled daily on settlement price at which the trading is closed in the exchange. That's called settlement price. The process of marking profits or losses that accrues to the traders on daily basis. Market participants, okay, be the broker, buyer, or the seller, they earn the profits and losses on daily basis rather than at the maturity in case of the forwards. There are some important objectives of this margin system. That is futures contract, which should be daily settled and not at the end of its life. When there is any decrease in the futures price, the buyer of the futures incurs a loss and the seller would gain. Then hence we can find that the margin account of the long position is debited. That is a buy position is debited. Simultaneously, margin account of seller is credited with the same amount, which brings the value of contract to zero. This makes a futures contract more attractive than the forwards contract, since the futures holder receives the cash on daily basis. Let us see, last but not the least, the last part of the third module, that's futures payoff. What do you remember payoffs? Very important question. Profits or losses earned from the derivative futures derivative trading. So here, cash realized by the traders by the market participants in derivatives will be at the end of its life. Net cash flow occurring when the position in the futures is closed on the maturity date. Now, there are two types of investors, as we know. Basically, the long-term long investors and the short investors. So the long investors are the investors who are ready to take the buy position, that is a long position, and short investors, they are who are taking the position of short selling position. So what happens here is that profit here, in case of the long investors, the profit is equal to spot price at maturity minus the futures price, right? But it's just the opposite in case. The profit position of the long investors is just the reverse of the short, the loss position of the that is of the short investors. So if you compare the profit of the long investors, spot price at maturity minus futures price, the same would be the loss in case of the loss of the for the short investors. Loss is equal to spot price minus spot price at maturity minus futures price. In case of the loss for the long investors, that is loss is equal to futures price minus spot price at maturity. It will be the profit in case of the short investor. That is profit is equal to futures price minus spot price at maturity. So these are the important highlights for today. Okay, I hope it is very clear for you. Thank you. Have a nice day. With this, your third module is completed. Thank you.